All right, today we're diving into a concept called contrarian execution. It's this really cool strategy for spotting opportunities right when everyone else is hitting the panic button. So let's jump right in. But hang on, first things first, the really important stuff. Please remember that everything we're about to cover is purely for educational purposes. This is absolutely not financial advice. Okay, so let me ask you something. When you see a price chart just suddenly nosedive, what's your first reaction? Do you see a total disaster, or do you maybe see an opportunity hidden in there? Because the strategy we're unpacking today, it's all about seeing that opportunity. We are talking about the contrarian reversal. And at its core, this whole thing is about trading against the herd, going against that prevailing panic you see in the market. So what does that actually mean? Well, a contrarian strategy is pretty straightforward. When everyone else is freaking out and selling, you're looking for a reason to buy. And when everyone's getting greedy and buying up everything in sight, you're looking for a reason to sell. You're basically deciding to swim against the market's emotional current. And if you want to boil it all down to one simple idea, it's this: buy the latest weakness or sell the latest strength. That's it. It's a super powerful concept, and we're going to break down exactly how to apply it. Okay, let's kick things off with the first scenario: buying the latest weakness. I'm going to walk you through this with a real chart example, step by step, so you can see exactly how it plays out. All right, so take a look at this chart. Step one starts with this sudden, really sharp price drop. The source material actually suggests this is often a manipulation play, right? Designed to shake people out. But what it does for us is it creates this critical area, that yellow zone you see there. That's our new support and resistance zone. Now, here comes step two, and listen, this part is absolutely key. We don't do anything yet. Seriously, patience is your best friend here. We're waiting for confirmation. And what does that look like? It looks like a strong, sharp, decisive move back above that yellow zone. We're not talking about a slow, lazy crawl. We want to see power. And that brings us to the final step: pulling the trigger. After that big breakout, we wait for the price to come back and retest the top of our yellow zone. That is our entry point. From there, we'd place our stop loss just a couple pips below the zone to protect ourselves. And we set our initial profit target at that most recent high you see marked up there. Awesome. So now that we've got the buy side down, let's flip it around and look at the opposite: selling the latest strength. And as you're about to see, the logic here is a perfect mirror image of what we just went through. Here in step one, we see the price rally up into that supply area, that yellow zone. But instead of pushing through, it just runs out of steam. The sellers take over. The key moment for us is when the price then breaks down hard, right below that zone. And just like in our first example, we don't jump in on the breakdown itself. No, we wait. The higher probability entry comes when the price rallies back up to retest the underside of that same zone. That's our sweet spot to look for a sell entry. And this brings up a really, really important point. The quality of that reversal matters a lot. A strong, sharp, aggressive move back, that screams conviction. But a slow, weak, choppy reversal, that tells you there's just no real momentum there. Bottom line, the sharper the move, the better the signal. Look, knowing the pattern is one thing, but actually trading it, that takes rules. And in trading, discipline is everything. So let's lock in the framework for how to actually execute this. Let's just simplify this whole thing down. It's really just a 3-step process. Step 1, you identify the zone that was created by that big, sudden move. Step 2, you wait patiently for that sharp reversal back through the zone. And step 3, and only after the first two happen, you enter on the retest. That's the whole playbook right there. And here is a rule that you just cannot break. It's non-negotiable. Before you even think about placing a trade, you have to check the risk-to-reward ratio. Your potential profit, your target, has to be at least 3 times bigger than your potential loss. If it's not at least 1 to 3, you just don't take the trade. End of story. This table here lays it out perfectly. If you're buying, your stop loss goes just a pip or 2 below the zone, and your target is the latest high. If you're selling, your stop loss goes a pip or 2 above the zone, and your target is the latest low. It's clear, it's simple, and it's mechanical. Okay, now for a quick reality check. It is so important to understand this is not some kind of holy grail strategy that wins 100% of the time. Nothing like that exists in trading. In fact, you are going to have losing trades. You're even going to have losing streaks, where maybe several trades in a row don't work out. That is a completely normal part of this game. And that's why this right here is the most important rule of all. Proper risk management, I'm talking only risking a tiny percentage of your capital on any one trade, is literally everything. It's what keeps you in the game long enough to catch the winners. All right, so as we start to wrap this up, let's just boil this all down to the key things you really need to remember. Okay, here are the 4 big takeaways I want you to burn into your brain. First, the sharper the reversal, the higher the probability. Second, patience is your superpower. Always, always wait for that retest. Third, never ever take a trade that doesn't offer at least a 1-to-3 risk to reward ratio. And fourth, this setup is often most powerful on lower timeframes when it's moving against the primary trend on a higher timeframe. And I'll leave you with this last thing to chew on. After seeing a clear, rule-based strategy like this one, what do you think is ultimately more important for a trader's success? Finding a perfect strategy or having perfect discipline? Something to think about. Thanks for tuning in.